Our next guest says if it weren't for the Warner Brothers bid, the stock would be higher. CNBC contributor Tom Rogers joins us now. He's a senior advisor at our parent company, Versant Media. Tom, great to see you.
Great to see you, Melissa.
So WBD, it's all WBD's fault, but would you want Netflix to own WBD in the end?
Look, I think Netflix wins when it comes to long-form entertainment, whether it does the Warner deal or not. The story is fully intact. As is often the case with Netflix earnings, market overreacts. Strong revenue growth, margin expansion. There was some analyst disappointment with the extent of the margin expansion, but there are 30% margins. Disney, the #2 player out there. Netflix has 7 times the EBITDA of Disney streaming at this point. And more importantly, they're continuing to grow. Margins have pointed to that. I think there's a clear path in the next few years to 40% margins, and you're beginning to get into the kind of territory of cable program networks in the heyday when everybody pointed to that as the best media model known to man. So I think the core story is still very much intact, but of course the Warner deal is an overhang.
All right, I'm going to blow a little smoke, Tom, which is my want to do. You were a bull in Netflix forever until June of last year. They reported earnings. You came on this show and you said there were a couple things in the earnings release that you didn't like and you thought the stock could act in kind. $50 later, here we are in the mid-80s. So is it enough off the top to say, you know what, it looks interesting again to a Tom Rogers?
Well, what bothered me most then was engagement, and it had trailed off some. They came back this quarter. The good thing about that is they had a strong slate, which shows that the strength of their content budget, their program spending, does pay off. And when they put a strong slate together, engagement moves. And you can't take anything away from the fact they had the #1 TV series, original TV series of streaming of the year with Squid Games, and they had the #1 original movies with K-pop. So that was the thing that most bothered me. They've recovered some. I think what is a threat here, so I'm still a bull, but I am a tempered bull still, and that is the things I don't think the market is that focused on. As I said, they're going to win long-term engagement, long-form programming engagement, one way or the other, deal or no deal. But the threats that they face are short-form engagement. Short-form television is growing more rapidly. That user-generated AI is coming on board. Fast channels, free streaming services are growing really nicely. And maybe the biggest threat, professionally generated AI content, which can take what are today huge $100 million and bigger movies and maybe reduce their cost in the next 3 or 4 years down to $10 million. That really works against the hugest competitive advantage that Netflix has, which is an enormous content budget. If you can begin to make great looking stuff at a fraction of the cost, that's going to be a competitive threat that I think they have to worry about. Problem with Warner is it pulls them in the direction of legacy long form, legacy distribution like movie theaters, and away from focusing on those things that may be the bigger threat.
Hey, Tom, it's Karen. Thanks for coming on. So to your point about content creation costs going down, clearly as a giant content creator like they are, you would think they would be the beneficiary of that as well. Do you just think the competition being able to do, create great product overwhelms the benefit that they would have and their ability to create a lot more content for a lot less money?
Yeah, that's true, but it democratizes the ability to create great content and takes it well beyond those who have these enormous program budgets. And I think that is a bigger competitive threat than I think it is a benefit for them. Yes, absolutely. Having said that, I think it's one of the key reasons that regulators ought to look at this, and if Netflix is the winning bidder here, approve them. Not only today do they have only 9% of television share, and HBO Max adds all of 1.4% to that, but these other brewing issues, from user-generated content to professional AI-generated content, are things that I think are going to create a much more competitive environment for them over time. The near term and intermediate term, they win long-form entertainment, and that's where the game is.